Hello, everyone, and welcome to today's webinar entitled, When is it not a good time to incorporate? This is a reshoot of a webinar that we did earlier this week. We had some technical difficulties, so if you were attending that and you're thinking, that doesn't look like the webinar I attended earlier, you're quite right. We had to reshoot it just to address the technical difficulties that we encountered. The material is the same. We've pulled out the questions that were asked and again addressed those as we did in the original, but unfortunately, due to technical difficulties, we were unable to give you access to the original. So we hope this one brings back your memories and recollection of the content that we covered. As I say, it's the same material. So don't hesitate, continue to watch. It's what we've covered in our previous session. And as before, I hope you find this useful once again. Thank you for your understanding. This is a topic that I encounter daily with clients and those that are considering whether or not it makes sense to incorporate. So we're going to look this evening just at the topic of whether of incorporation itself, with no particular agenda here. In some instances, incorporation doesn't make sense. In other instances, it does. So my role here is to give you both the qualitative and quantitative considerations with respect to this topic to make you better informed to decide for yourself as to whether or not this makes sense. So with that having been said, let's move on and we'll cover the agenda for this evening. And you can see on screen, we are going to be talking about incorporation itself, explaining the concept. Should you consider incorporating your medical practice? The most common reasons why you may choose not to incorporate. Incorporation savings and costs quantified. Common myths about incorporation and how to compare your options. So that's our agenda for the next few minutes. So what is a professional corporation? I think where we want to start with this in order to answer this question is, by default, if you are not incorporated and you're practicing medicine, whether it's in Ontario or any province, you are a sole proprietor. You are a physician that is unincorporated, you are an independent contractor, but the tax status that you want to keep in mind is that of the sole proprietor, which means that as you earn income, the income is reported in its entirety on your tax return, your personal tax return. So that's by default where people start. Now, we'll see as we progress through the slides that the taxation at the personal level, the tax that you and I pay on income that we earn personally, increases, whereas the tax of a corporation is a flat tax. But to answer the question with respect to what is a professional corporation? A professional corporation is a new and separate legal entity that now becomes the owner of your medical practice. You practice through that entity. The income you earn doesn't come to you personally. It's redirected into the bank account of a corporation. And then from there, you decide on how much money you need to withdraw. And so that will just give you an idea. All the revenues that you earn now go through that bank account, that corporate bank account. The expenses you incur, it now has assets and debts separate from you. And so those are the distinctive characteristics of a corporation in comparison to the status that you have right now if you've not yet incorporated. So for example, if you have an examination table or a computer and you're a sole proprietor, any of those types of assets you will own personally. Whereas if you incorporate, then those assets would be purchased by the money that's generated inside the corporation. They would be purchased by that corporation, and that corporation now owns the examination table or the computer or the desk or chair or any of those things. So it's a separate and legal entity. Should you consider incorporating your medical practice? These are some of the considerations that you will want to give thought to as you consider this this option. With incorporating, you now would have the ability to defer tax payments. That means that unlike somebody who is unincorporated at present, if they earn $300,000 a year and they only have $80,000 of living expenses, they have no choice but to report $300,000 on their tax return. They don't have the ability to defer it. Whereas the corporate tax rates are substantially lower than personal tax rates, both federally and provincially. So there is where the deferral occurs. It will give you, if you choose, or if somebody chooses to incorporate, it will now give that individual the ability to control the amount of income that's reported on their personal tax return. And so we'll see in a minute why that's important. It will also lower your risk of audit potentially. And what I mean by that is that CRA will audit personal tax returns, and in particular a couple of schedules and a couple of lines that will, if you're operating as a sole proprietor, will attract their attention. Now, that doesn't mean you've done anything wrong. It just means that there's a higher level of scrutiny in all likelihood when an expense appears on a personal tax return in comparison to it flowing through the accounts of a corporation. Probably the most understated reason for incorporation, and in actual fact was the original idea behind incorporation. Most people think of incorporating their medical practice because of the tax advantages. But when you operate through a corporation, it also enables you to shield your personal assets from litigation. And I've given a couple of examples here, but if you're a sole proprietor operating as a physician and you have an employee, for example, and they're a long-standing employee, and you turn around and fire them one day and they turn around and sue you in response for wrongful dismissal, they are not only just suing for that, now all of your assets, your personal assets, with some exceptions, but your personal assets are laid bare for them to go after. Or you might find yourself in a situation where somebody slips and falls on the ice outside your office and they turn around and sue you. If you're unincorporated, then they can go after your personal assets in their claim. So the reason that incorporation first was brought into being was to enable those that were in business to contain the assets that they have and prevent others from going after their personal assets. So the idea is you would now have a professional corporation, you would hire your staff through that corporation, you would enter into your lease agreements through that corporation, all your commercial activity would go through that corporation. And if anybody sued you, the most that would be at risk would be the assets inside that corporation. Your house, your other assets and investments and things like that would be off the table. I say that on the assumption that there's not been any illegal activity going on, because in that case, that would what they call pierce the corporate veil, where there's illegal activity. But assuming that's not the case, then there is protection from shielding personal assets. That is a big consideration. All right. What are some of the most common reasons why you may choose not to incorporate? Well, maybe you're a shareholder of another Canadian-controlled private corporation. This oftentimes happens. This is more common in the past than it is now, but oftentimes we would advise clients that when their children were going through medical school or dental school, university, that the child become a shareholder of their parents' corporation, so that dividends could be paid out to the child who had little or no income. It would be taxed at a lower rate. That is now no longer a common practice because of changes in tax rules. But what we still find on occasion is that a physician is still a shareholder in a parent's corporation, and we would want to make sure that was not the case before they incorporated, if they chose to do so. Second reason you may choose not to incorporate or delay incorporating is when you're considering moving to another province or a jurisdiction. When I mentioned in a couple of slides ago that the income you earn from your medical practice will now flow through the professional corporation, it's the income that you earn in the province that your corporation is set up that flows through your corporation's revenue accounts. But if you, for example, incorporate in Ontario and you do some locums out in BC, the income you earn in BC does not flow through the Ontario corporation's books. That's your personal income. So you would still have to report that personally, while at the same time reporting the income from your practice of medicine in Ontario that income would go through your corporation. So when a person is considering moving to another province or jurisdiction, you would want to give some consideration to whether or not it makes sense to incorporate at that point or wait until they've moved to that new jurisdiction. Another reason why people may choose not to incorporate is the perception of complexity from being a U.S. citizen. And so we'll deal with this a little bit later, but that can be a reason why people choose not to incorporate. And then when waiting for permanent residency, if you're not a permanent resident of Canada, you're not permitted to incorporate. So those are reasons why you may choose not to incorporate. Now, so why do healthcare professionals incorporate? I've hinted at this, but this slide is intended to give you a visual depiction of how we are taxed as individuals versus how a corporation is taxed. And so you will notice on the left panel that the behavior of tax for an individual is as follows. As their income increases along this axis, you will notice the tax rate increases on this axis, such that in Ontario, when you hit $220,000 of income, you can notice that every dollar thereafter is taxed at 53.53%. So as your income continues to increase, your tax rate goes up. That's not desirable. And oftentimes what happens is residents getting into practice, for example, they will be used to making $65,000 to $100,000 a year, depending on the area that they're in. But then once they finish their residency and move on to the next phase, their income goes up substantially, and so does their tax. And so that's what makes people look at corporation. And what's different on this panel is the fact that there is a flat corporate tax rate. Now, we've listed it at 12, this is an old rate, it's 12.2% now. It was 12.5%, but you can see what happens from zero to $500,000 when income is earned in a corporation. It is earned, or the tax 12.2%. It's a flat tax rate on the first $500,000. It increases thereafter, but again, it's a flat rate, unlike the individual tax, which increases as income increases. All right, now notice then what we're dealing with here, which is the deferral of tax. So this slide points out the fact that if you earn income at $220,000 or above that rate, and you do it as a sole proprietor, your tax rate is 53.53%. But if you were to incorporate that income, you would defer 41.33% of that tax by flowing it through a corporation on the first $500,000 of active business income. That's income earned from the practice of medicine or the practice of dentistry, but it's active income. And once you hit $500,000, in a simplistic situation, then your deferral drops. Why? Because your tax rate, as you'll see over here, you would have seen it on the previous slide, the tax rate increases to 26.5% from $500,000 and above. Now, in some cases, it can be at a lower rate it increases, but for simplicity's sake, you can think of it behaving in that fashion. So corporate tax is a flat rate tax, whereas individual tax isn't always a flat rate tax. All right, so let's look at two scenarios here. This is where I find we can move beyond the conceptual discussion to actually look at numbers, and this is what people are interested in doing. So we're going to look at two scenarios. The first is somebody earning $220,000 a year, and when I say earning, that means after taking into consideration their expenses, the income that's subject to tax is $220,000 a year. So we've taken into account overhead expense, we've taken into account professional dues, cell phone, automobile, all those things. What's left over after those expenses are deducted, $220,000 a year. Scenario two, we go up much higher, over $500,000 to $800,000, just to show you what happens to the tax. All right, so let's make this real. Scenario one, somebody is earning $220,000 a year. The amount of money that they actually need to live on is only $82,500. They don't need the full $220,000. They're not yet incorporated. They're considering whether it makes sense to incorporate. If they stay the way they are, then their tax, their costs of professional fees for tax advice, tax return preparation, typically is between $1,000 and $1,500 a year. So we've picked a midpoint at $1,250 for professional fees for a sole proprietor. If somebody incorporates, then the costs of professional fees increase, and the marginal increase in expense on that's about $3,250. Typically, fees for professional corporation are about $4,500 a year. So we've taken that into consideration. When I use the figure of $82,500 per year, it means the person actually needs about $7,000 a month, or $6,875 to be exact. And so let's see what happens when they stay as a sole proprietor versus incorporating. All right, this screen, lots of colors, lots of columns, lots of notes, lots of numbers. Let's break this down. All right, so in this column here, for somebody who has not incorporated, this is their tax situation if they earn $220,000 of income. They earn $220,000 of income, they will have professional fees, they'll have income tax, they'll have Canada Pension Plan. On $220,000 of income, they're left with $135,474 after tax. About $85,000 is gone in tax and professional fees on $220,000 of income. All right, then they decide, or they're at least considering, what if I earn that $220,000, but I earned it through a corporation? I know I only need $82,500 a year. What's the outcome of that? And that's in this column here. So this is if they draw out $82,500, they draw it out as salary. What's the outcome of that? Or they have a second option. So when you incorporate, you now have at least two options for withdrawing funds: salary or dividend. What's the outcome of each? So 220 goes into the corporation, the person takes out only what they need to live on, 82,500. So what's the outcome of that? That's down in this box here. So here we know the person only needed 82,500 to live on. Their tax costs in this section here was $85,000. If they incorporate, their tax cost is about $53,000. They defer $32,533 in tax. There's a tax deferral of $32,533. That means that there is a tax liability should they take that money out of the corporation, but so long as the money stays in the corporation, that deferred tax can be invested and you can earn investment income during the course of that. And that's each year. So if the person continues to earn $220,000 and they draw out only $82,500 a year to cover living expenses, they can expect to defer $32,000 a year in tax, which can be invested and you can earn investment income on that. All right, that's option one. But what if the person said, no, what about drawing out as a dividend? What's the outcome there? So they take up the same $82,500. The corporation still earns $220,000. But in this case, then, the amount that's deferred is $37,000, almost $38,000. So they are paying about $47,000 in tax instead of $53,000. And you can see the deferral increases to about $38,000. So you've got some options here. I'll talk in a moment about why there's a difference. But the other consideration here is the person is saying in the first scenario, you know what, I only need $82,500 to live on, but sometimes what happens, the person may be thinking in a couple of years I'll buy a house. For now I don't need to buy a house, but then all of a sudden they take a drive on a long weekend and they find the house of their dreams and they think, you know what, I really like that house. And so all the planning that's taken place beforehand is off the table. The person says, I want to take all my money out of the corporation now because I need it for a down payment. And so the question then becomes, so was it worthwhile for the person to go through the trouble of incorporating in the first place? Should they not have just stayed as a sole proprietor, paid the taxes they go and so on? Was it a good idea? Well, let's look at that. In that situation, remember, if they stayed as a sole proprietor in this column, they would be left with $135,474 after tax, CPP, and professional fees. But they incorporated and they drew out the whole amount of the income that was earned, the $220,000 after expenses. And what they're left with after that, when they draw it out as salaries, they're left with $134,622. So compare the two. What's the difference? The difference is $852. That is not a big difference, right? It's $852 more if they take out salary, but you might have thought it would be much higher than this. This is quite a small amount of difference. All right, what's the third scenario? The person says, give me all the money, I need it for my down payment, but give it to me in the form of a dividend. What's the difference then? Well, they would have received after tax $135,474, but in this case, they took it out as a dividend. Well, look at that. So if somebody's considering that whether they should incorporate or not, in this case, they actually are left with more in their pocket when their income's $220,000 flowed through a corporation, drawn out as a dividend. Look at that, they're $1,800 ahead by incorporating, and that takes into account professional fees. So that just gives you an idea of the flexibility that you're provided with an incorporation that somebody doesn't have when they're a sole proprietor. All right, let's look at scenario 2. Somebody earns $800,000, and I picked this number because it's above $220,000, it's above $500,000. And let's see what tax starts to behave as, how tax behaves at this level. So again, the individuals now earn $800,000. They could earn it as a sole proprietor. We'll see that as an option, or they could earn it through their corporation. They still only need $82,500 to live on. And we take into account the same professional fees in the analysis as well. Let's move on and see what this one looks like. All right. Same schedule, different numbers. So the sole proprietor in this column earns $800, and on $800 is left with $322,000. I'm sorry, that's not true. Is left with $405,000. So they're spending $394,892 in income tax. What if the person incorporated, earned the $800,000 in the corporation and took out only what they needed, took out the $82,500, and left the rest inside the corporation? How much tax would they defer in that case? Well, look, $246,000 deferred. That money can again be invested. This, if they continue to earn this level of income and nothing changed, this would be the amount deferred year after year. And so that amount of deferral would be invested and they would earn investment income. What if the person said, no, let's me take out the money I need to live on, but let me take it out in the form of a dividend? What's the deferral look like there? Well, look at what happens. It changes slightly. It was more advantageous when the income was lower in that fact pattern. In this case, the deferral is actually 245, call it, instead of 247 here. I'm rounding, but that will give you the idea. Now, what if the person says, you know what? Remember I said they found a house that they'd like to buy. They're pulling all the $800,000 out. What's the tax cost or the tax savings of having incorporated and then flowed the income through the corporation versus staying as a sole proprietor? Well, let's look. Again, down here, sole proprietors left with $405,000 in their pocket versus the individual who incorporated and took all the money out through a corporation in the form of salary, $404,367. Difference, $741, a little less than in the previous slide. So again, very little difference to incorporate, but to have more options. And then in the third scenario, which is where the person takes all the money that's in the corporation out, but they draw it out as a dividend. Well, actually, because dividend tax rates are higher in some instances, you can see the cost here is actually $5,923, whereas it was $1,801 of savings beforehand. So an interesting outcome as incomes vary. What's that tell us about this? It means that in every scenario, you want to run the numbers. You can't just extrapolate because of the complexity of the various items that are calculated in these calculations: tax, CPP, dividend tax versus employment or salary-related tax. All right, those are the numbers. That quantifies for you a couple of scenarios with respect to incorporating. Now, what are some of the common myths that I hear? These are the common objections or ideas that I, if not daily, weekly. Firstly, incorporation doesn't make sense until I've paid off my student loans or other debts. That is a myth. And the reason I say that is because each one of us, you and I, will never pay off all of our debts. I'll explain that in a moment. The second common myth is incorporation doesn't make sense until I've saved money for a down payment for a house. The third common myth we'll deal with is incorporation only makes sense if I keep between 50 to 100,000 per year at a minimum inside of a corporation. Myth number 4, is there an optimal time for me to incorporate? And myth number 5, I'm a US citizen, I don't think I can incorporate in Canada. All right, let's deal with the first myth. Incorporation doesn't make sense until I've paid off my student loans or other debts. I started out by saying, you and I will never be debt free. And that may sound like hyperbole, but I mean that in actual fact. You and I will never be debt free in our lives. And the reason for that is that even on the time of our passing, we will leave a debt behind. What's the debt? It's income tax. So this idea that you should pay off all your debt before incorporating is a myth. If logic followed, we would never incorporate because we would never be debt free. So take that for what it's worth. Incorporation does make sense even if you have debt. So that's the first myth. The issue here with respect to corporation is about controlling the amount of income that goes on your tax return, your personal tax return. That's what we're getting at here. Whereas when you're a sole proprietor, you have no control over how much money is reported on your personal tax return. The more you earn, the more you'll pay in tax in that situation. All right, myth number 2, incorporation doesn't make sense until I've saved money for a house. I will give you a scenario in a couple of minutes where we can see that in actual fact, incorporation does make sense. And we've already seen that in those scenarios where somebody was earning $220,000 and they could flow the income through their corporation and still come out ahead. So this idea that incorporation doesn't make sense until you've saved enough money for a house, again, is a myth. Well, actually, before we get to myth number 3, let me run you through 2 scenarios to demonstrate that. Scenario number 1, home purchase. The price of the home is $2 million. The down payment required, 20%, $400,000. Dr. Smith has $50,000 of money set aside for the down payment. $350,000 will be needed in the next couple of years to finance the purchase of the home. Dr. Smith earns income through a professional corporation, so they're incorporated. But they leave all of the money that they're earning inside the corporation for the next 3 years in anticipation of drawing it out in year 3 in order to make the down payment on the home purchase. So we're looking 3 years hence. And so if we follow that scenario, and in each year, year 1, the income was earned inside the corporation and no money was drawn out. This is the scenario. Year 2, same thing. In year 3, the person takes up all the income that's been earned in the current and past 2 years, $660,000. And you can see here the income tax they will pay on that is $312,368, leaving them with $347,632. I worked these numbers so that the person, the amount of money going into the corporation was roughly the top tax bracket of $220,000 in Ontario. But here you can see they're well in excess of that at $660,000. And so here's the tax bill. Here's what they're left with, $347,000, roughly enough to make up the difference that's needed in addition, in combination with the $50,000 they've already saved for the $400,000 needed for the home purchase. All right, let's look at scenario 2. Same home, same purchase price, same amount saved beforehand, and the same amount needed 3 years hence. What's different? Well, in this case, each year the person takes out of their corporation $220,000, whereas before they waited until year 3. $220,000 taken out will yield $76,000 in tax, leaving $143,000 after tax for this individual. I've ignored CPP in here. We're just looking at the tax. So $143,000 is available. They can put that inside of a TFSA if they wish. They can put $35,000 of it into an RRSP for withdrawal in the future for the home buyer plan, but they've got $143,000 out of the corporation after tax for each of the 3 years. Let's compare. Scenario 1, the person waited until year 3 to take out $660. Scenario 2, the person took out $220 for 3 years. What's the outcome? Here, the tax cost of taking it out in 1 year, $312,000. Look at this. The tax cost of taking it out over 3 years, $230,000. The savings, $81,539 in savings. If somebody says I should only wait and incorporate afterwards, I would differ with him and I would use this scenario to build my case. So in this case, to summarize, the marginal tax rate for income in excess of $220,000, we're talking about in Ontario here, is 53.53%. Incorporation provides you the flexibility to put strategies in place to minimize tax as you go. So for things like debt repayment, if you have student debt or a home purchase or an auto purchase or investment purchases outside of a corporation, you have a lot of flexibility with a corporation you don't otherwise have. And this is just an example of our ability to control the amount of income that's reported on an individual's tax return. Remember, the amount this person was showing on their personal tax return each year was set to the top tax bracket, no more. So that's the flexibility that you get with using a professional corporation. To put it another way, here's year 1, year 2, year 3. I'm just demonstrating with this the fact that we control our tax by taking income up to $220,000 on our personal tax return so that we never pay $1 of top tax rate, $1 of tax on income in the top tax rate. We do that for 3 years. That's the planning that went into scenario 2. Myth number 3, incorporation only makes sense if I keep between $50,000 and $100,000 per year in a corporation. You know, the problem with these myths is that they generalize. And it would be the same as if you were dealing with all of your patients the same way. You know, every patient profiles differently. They have different extenuating circumstances, different health histories and things like that, different fact patterns. So when I hear somebody say, oh, well, it doesn't make sense to, unless I've got $50,000 to $100,000 to leave within a corporation, it just isn't true. I'll give you an example. I have a client, they are an employee of a hospital. So they're not at this point incorporated, but part of their remuneration package each year is that they get a bonus of about $30,000. And that bonus gets paid out to them quarterly. They're earning $350,000 a year. Remember what I said about tax brackets? Well, in this case, if they're earning $350,000 a year, it's about here, and they're paying a substantial amount of tax in the top tax bracket. And then they get another $30,000 bonus. They don't need the income. So why not incorporate and send that bonus and just let the bonus of $30,000 sit inside their corporation? They would pay tax on that at 12.2%. This idea that there are these hard and fast rules that you shouldn't consider incorporating at all if you've got these figures just is a myth. Is there an optimal time for me to incorporate? This idea does make me chuckle because it would be like me saying, yeah, do it next Thursday at 2 o'clock. It's not that precise. There are indicators that you can look at to assess whether or not the structure of a corporation makes sense. What are those indicators? Well, is my income increasing, or is it expected to increase in the next little while, such that I'm going to be earning more than I need to live on? Another reason that you would want to consider incorporating in general, as a general indicator, rather than trying to time it, it's like timing the stock market. You can't do it. Well, in the same way, maybe you've earned a lot of income this past year, as a sole proprietor. What's the implication? You're going to have significant personal tax installments this year. Somebody earning $220,000 last year would have paid tax of about $80,000, $80,000 to $85,000, and their installments this year, in addition to the fact that they just paid $85,000 in tax at April 30th for last year's income, now CRA is going to send them a written request for installments for September of this year and December 15th of this year. $42,500 in September, another $42,500 in December. You heard me right. They will have cash outflow this year for income tax of $170,000. That to me is a good indicator that I want to consider controlling my income and consider controlling my income tax installments through incorporation. So that's the indicator. So in response to this idea, there's an optimal time for me to incorporate, I would suggest there are some indicators that would suggest to you whether it makes sense to incorporate or not. Another myth is that I'm a US citizen and I don't think I can incorporate in Canada. Not true. We have a lot of clients that are US citizens, and we just take into consideration the unique factors that impact their US taxation. But that doesn't mean if you're a US citizen that you're prevented from incorporating. You can still incorporate. The unique factors, for example, that you would want to take into consideration is level of income, for example, how much money you're going to take out of the corporation, or the year end. For example, you would want to, for practical reasons, have a December 31st year end date, whereas with somebody who's not a US citizen, they could have a year end at any time of the year, any month end, any date of the year, they could have a year end date. And you could still do the same with a corporation for a US citizen, but it does add some complexity in terms of calculating amounts for the determination of US tax. So we will use a December 31st year end just to keep things neat and tidy. All right, so let's compare our options. These are the qualitative factors to consider now. If you're a sole proprietor, the income you're earning is self-employed income. That income will attract CPP premiums. You have no choice but to pay them. That's not a bad thing or a good thing. It's just a characteristic of the income that you're earning with when you're a sole proprietor. You'll see in the other situations that you have a choice if you incorporate as to whether or not you draw out income that will require CPP premiums to be paid or not. You can take out dividends, and there are no CPP premiums levied against dividends that are drawn out. Self-employed income will create RRSP contribution room. So if you're one of those people that it's a high priority to contribute to an RRSP, then as a sole proprietor, you can do that in the same way that you could contribute to your RRSP if you incorporated but drew out money in the form of a salary. Incidentally, on our website is a video which we did recently on RRSPs and whether or not it makes sense to have some of the tax strategies around RRSPs. If you'd like to take a look at that, it may give you greater clarity around the role of RRSPs in professional corporations. The next characteristic that a sole proprietorship will give you is it will give you access to SR&ED claims. That's SR&ED. What is that? That's scientific research and experimental development tax credits. But notice this, when you're a sole proprietor, the amount of the tax credit that you will have on those SR&ED expenses is 15%. If you operate through a professional corporation and have the same expenses, notice it increases to 35%, and it's a refundable tax credit, meaning the government will cut you a check. In this situation, the government's not going to cut you a check, but they will give you a credit against your income tax, provided that the income tax exceeds the amount of the SR&ED credit. But if it doesn't, you'll have to carry that tax credit forward, but it's not a refundable tax credit. The other characteristic with a sole proprietorship is there's no options to defer income tax. As I mentioned, what you earn is what you report, whereas in these two columns, we can decide how much income sits on your personal tax return. All right, so the main advantages or benefits of incorporating, it gives you the option to defer tax. It enables you to control the amount of income reported on your personal income tax return. It reduces the risk of audit from CRA. And as I said earlier, it enables you to shield your personal assets from litigation, a big consideration. Now, this is the next topic we're dealing with is an area where people kind of struggle. Should I incorporate or not? They know how much they're earning, they don't know how much they need to live on, and this is very common. And so I want to give you a back of the envelope calculation, a way of calculating that shouldn't take you more than 30 to 45 minutes. I don't want you creating a crazy spreadsheet. This is a back of the envelope calculation to give you an estimate of your monthly living expenses. Here we go. We start out with your bank statement. So look on your bank statement for the last 4 to 5 months. I've used 5 months in this situation, but I want to look on my bank statement for the total withdrawals. What's the total amount of money that's come out of my bank account each month? And so you can see the amount that came out. Now, we need to make some adjustments here for a couple of items. Firstly, are there practice-related expenses that I'm paying for out of my personal savings, out of my personal bank account, like CMPA, CPSO, OMA, cell phone, travel, conferences. Because if there are, I want to take those out. I want to remove those expenses from this total. Why? Because my professional corporation is going to pay for those in the future. So I will not need extra money since my corporation will be covering off these expenses. So take those out. When you go through your bank account, remove those. One step further, look on your credit card statement, because if you're paying off your credit card every month, then the payments for those one-time or those practice-related expenses may be sitting on your credit card. So don't just look on your bank statement, also go to your credit card and identify them there as well, because that money is coming out each month one way or another out of your bank account, whether it's directly out of the bank account or through your payment of your credit card bill. Next, take out one-time purchases. What do I mean by that? A new furniture, a new car, a rental deposit, a down payment on a house, exam fees. These things are one-time payments. They are not part of your ongoing living expenses. So in this situation, the person paid for an exam fee of $2,800 up front. Take it out. That's not part of your regular living expenses. Look for those types of items. So start with practice-related expenses, take out one-time purchases. The last one is debt repayment. And by that, I'm not talking about your mortgage. I'm talking about if you have a line of credit or you have an OSAP loan or something like that where you have discretion. You don't have discretion with a mortgage. You do have discretion with a line of credit or an OSAP loan as to how much you're going to repay of it. Why do I say take that out? Take it out because we're going to come up with a separate repayment plan for that debt. So take that out of the equation just so we can get to what your current monthly living expenses are. Now, in this case, you can see what they are after we've made those adjustments, and we can see what the average is. This individual needs about $6,300 a month to live on. What's that mean? Well, it means they need, if $6,300 translates into about $75,000 a year, and on a pre-tax basis, that $75,000 a year is about $107,500 of pre-tax income. If they're earning $220,000, you know they've got a fair amount of money that can sit inside of a corporation and defer tax. So that's the purpose of this exercise. So I leave you with that so that you can go through that exercise and spend a half hour or so just figuring out with some degree of accuracy over the last 4 or 5 months what your living expenses are. Now, we're living through an odd period of time. Our living expenses may not be normal, so you need to take that into consideration here. But this gives you a framework to look at and to determine roughly what you need to live on. I put a couple of other notes in there at the bottom, but I think I've covered those off as I went through the numbers there. All right, so that will give you the qualitative and quantitative considerations to be considered with respect to the topic of incorporation. But are there any questions? And if there are, feel free to ask and let me jot away. Mustafa, have you got questions there?
Yeah, we have quite a few questions here. The first one is asking, what would be the next steps to continue with incorporating?
All right, so you have a couple of options. One of them would be to retain a lawyer to help you to incorporate a company. That's one option. The second option is that you have access as a physician to an incorporation service through the Ontario Medical Association. OMA Legal Services is a second option. We use that a lot for clients that are incorporating, mainly because it's inexpensive and they do all that's needed in terms of getting up a simple corporation up and running. So that's option number 2. If you go with a lawyer, you're probably going to spend anywhere from $1,000 to $1,000 and up to just get incorporated, and then you'll have $400 of fees to CPSO. Whereas if you use OMA Legal Services, my recollection is the fee is about $543. It's an online process, so you just log into your OMA account, and then there's a hyperlink that will take you to the incorporation form. Don't do that on your own. I will encourage people, if you do, there will be questions in there that you won't know. how to answer, and it will cost you more money to fix the mistakes you make when you go through that on your own. So it typically takes about 20 minutes. I would normally set up a Zoom meeting with somebody and then just look over their shoulder as they go through the form and give them some direction in the areas, in the questions around shareholdings and directors that they may not otherwise know how to answer. And then once the corporation's set up, then you notify the parties like OHIP or the hospitals or the clinics that you're working at, that you now are operating through a professional corporation, that future payments should be going into that corporation, that new corporation's bank account. So you'll set up a corporate bank account. The money no longer goes into your personal bank account. So those are some of the next steps in terms of incorporating. So I hope that helps. Typically, it would take about 20 minutes to go through the OMA site. And once that's taken place, they will send you an email. You'll have all of the legal work attached to that in the form of attachments to that email. And then you file for a certificate of authorization from the College of Physicians and Surgeons of Ontario. And that'll take a couple of weeks. It costs $400. So between OMA, legal services, and CPSO, you can get incorporated for under $1,000. So I hope that helps. All right, next.
Is the corporation income also taxable?
Yeah, we covered that. Let me take you back to the slide previously, and I'll show you. So what we were considering in our slides was both personal and corporate tax, and I'll show you where you see both. In this case, I'm almost there. On this slide, you will see corporate tax, and it's in this section here, corporate taxable income, and here's the rates of tax. So when we did our comparison, we took into account the corporate tax, and then we took into account personal tax, which is in this section. So to answer your question, yes, corporate tax included, and income in our analysis, income earned through a corporation is subject to corporate income tax. And that's been taken into account in our illustrations.
This one's asking, who is the most qualified person to figure out whether or not it makes sense to incorporate? Would it be a financial advisor, accountant, or both?
Okay, so who is best able to determine? You cut out for a second there. I think you were saying who is best advised or best able to advise on when to incorporate or whether to incorporate or not. Is that right?
That's correct, yeah.
A financial advisor or an accountant. I would say an accountant. I know that might sound a little self-serving, but a financial advisor will give you guidance on personal investments, insurance products to manage your risk and things like that. And they will have some tax knowledge, but typically an accountant will have a broader understanding of tax and structures and things like that. So I would suggest that you would be best advised, or somebody would be best advised to work with an accountant on determining whether or not incorporation makes sense.
And is it possible to be incorporated in multiple provinces? And what are the pros and cons of that? For example, if I'm planning on working in multiple provinces for the next few years.
Okay, that is a great question. I think I mentioned earlier that as you earn income in your professional corporation, if you choose to incorporate, it's the income that is earned in that province that flows through the professional corporation. So if you're incorporated in Ontario, you earn income in Ontario, but you do some locums in BC because you can, claim your vacation expense or your travel expenses to and from as part of a work doing a locum and spend some time out there on vacation. Then the income you're earning in that other province, in BC in this case, would be earned personally. That income would appear on your tax return personally, and it would not flow through the corporation's revenue accounts. So keep that in mind. Now, I'll just take that one step further, because sometimes people say, okay, well, I'm thinking, should I incorporate now, or should I wait, because I'm thinking I might change my province. Or they've decided to change province. This came up actually just this past week, and somebody said, I'm moving to a different province. I guess I need to dissolve my corporation. And I said, not so quick. You've got a couple of $100,000 sitting in the bank account of that corporation. And if you dissolve the corporation, all of that money comes out to you personally as income, and you pay tax on that. So why not move the corporation from one jurisdiction to another? And you do that by filing articles of continuance. You remember, I think I've mentioned about articles of incorporation, and you'll hear these legal sounding terms like articles of incorporation, or if you want to change the name of your corporation or make some sort of change to it, you file articles of amendment. Well, another step or another option that this person had was to move their corporation from Ontario, in this case, to Alberta. And so they would file articles of continuance. So the articles of incorporation, that's like the birth certificate, if you want to think of it that way, of a corporation, that brings it into existence. Articles of continuance enable you to move it from one jurisdiction to another. And so, but it is possible, it is certainly possible to earn income in multiple provinces, but just remember that only the income earned in the province that you've incorporated, that you've received your permission from your college, can flow through that, unless you've decided to incorporate multiple corporations. So, and that I think is cost prohibitive in most cases.
I've heard it recommended to max out TFSA and RRSP accounts before incorporation is beneficial. Is this a myth or accurate?
All right. This is a common question. Should I leave the money inside of my corp, or should I pull it out and invest it inside of an RRSP? Should I max out my RRSP contributions? I would refer you to an article written by Jamie Golombek, G-O-L-O-M-B-E-K, I think is the spelling of his name. And this is an article, I think from last year, if I recall, which kind of analyzes the outcome of leaving money inside of a corporation and investing it there versus withdrawing it and then putting it inside of an RRSP and letting it grow there. That's the attractive option. People are oftentimes attracted by that. I'm not persuaded of that, and let me explain to you why. With a professional corporation is a quasi-RRSP. But I'll give you an example of a client who has put all of their investment earnings, even though they had a professional corporation, this was before we worked together, they pulled all the money out and they put it inside of an RRSP. And this individual is now just turned, they're 71, they're just about to turn 72. Why do I mention that? Well, when you invest your money in an RRSP, then you're allowed to let it grow inside the RRSP tax-free until you reach age 71. At that point, you have to put in place plans to roll that money out of the RRSP and into a registered retirement income fund. It's called a RIF for short. And that RIF then requires that you take out a minimum amount of money every year. This individual has about $3 million in their RRSP, and their spouse who passed away a couple of years ago left their RRSP, made them beneficiary. So this person now has a little under $6 million in RRSPs. The amount of income they're going to report from age 72 until the day that they pass will be at least $300,000 a year. They have no choice but to do that. When you invest inside of a professional corporation under certain circumstances, and bearing in mind that you have to be deliberate in terms of what you invest in, nobody is going to tell you when you're age 71 or 72 that you have to start drawing money out of your corporation. That is not a requirement. And so I would just say to people that have professional corporations or who can incorporate, you are fortunate. You have options that others don't have. If you're just an employee somewhere, you don't have the option to incorporate, yes, an RRSP makes sense. It's one of the few options you have for retirement. But when you have the option of using a professional corporation, I would not go crazy on investing money inside of an RRSP There would be times when it would be prudent to do that, but I wouldn't just default to that. All right, so I hope that answers helps answer the question. I wouldn't take out money out of a corporation to put it into an RRSP or into a TFSA unless there were certain conditions that required me to do that. But just I hope that addresses that question. Anything else?
Yeah. There is a common idea floating around that all of your registered accounts should be totally filled prior to incorporation. Do you agree with this?
I wouldn't say I do. And let me tell you why. Again, this gets back to this myth that there's a hard and fast rule. And I would say in this case that I would not make my registered accounts, maximizing out my registered accounts. And let me firstly explain a registered account, because you hear these terms like an RRSP, a registered retirement savings plan, a RIF, a registered retirement income fund, a registered disability savings plan, a tax-free savings account. Those are all accounts that are registered with the government. They're tracked by the government, and they have certain tax features or characteristics. It enables you to put money inside of those, and then you can generate income so long as the money's in there, tax-free. So I would not say that I would default to this hard and fast rule of saying I want to max out all of those before incorporating. I would say my first priority would be to get control of my personal income. So in other words, if my personal income is greater than $220,000 a year, then I would look at that and say, all right, I am paying tax on some portion of my income in the top tax bracket. I want to get out of that top tax bracket. That's priority number one. How do I do that? Either I incorporate or I contribute money into my RRSP so I can have a deduction. But the first priority I would have is not about maximizing my TFSA and my RRSP. My first priority would be getting control of my personal income and getting out of that top tax bracket, if at all possible. I had just jotted a couple of other items. I would definitely look at putting at least $35,000. If I was planning to buy a house, for example, if I hadn't owned a home in the last 4 years and purchasing a home was a priority, then I would certainly put $35,000 into my RRSP, because there's a home buyer plan, so you could get the deduction at the same time as getting access to the money. You could pull it out and not incur any tax on that. So that I would definitely do for sure. In a circumstance where you're a first-time home buyer, you haven't owned a home in the last 4 years that's been your residence. But I wouldn't let the registered accounts dictate your priorities. I would make my priority or my focus getting out of top tax bracket if that's where I'm at. I hope that helps. Anything else?
Yeah, this one's asking, does it make sense to incorporate if you plan on taking time off, such as maternity leave, in the next year?
Okay, great question. Firstly, just park this idea, but if you're not familiar with this, in Ontario, through the Ministry of Health and Long-Term Care, there is a program called, the acronym is PPLPB, which is Pregnancy and Parental Leave Benefits. And so that will enable a mother to take off 17 weeks and pay $1,000, assumption that there's no income in excess of $1,000 being earned. There's details on the Ministry of Health website. I'm just throwing that out there just as an aside, because sometimes people don't know. But back to the question of whether it makes sense to incorporate if you're planning to take time off. Again, it depends. What does it depend on? It depends on how much money you're earning this year. So I dealt with somebody this week where this question came up, and they were going to earn about $110,000 this year and then take time off next year on parental leave or mat leave. That doesn't make sense. $110,000 of income is not taxed at a particularly high tax rate. In that case, I said, don't incorporate. Not yet. Wait until you get through that period of time, and when your income starts to go up and stabilizes, that's the time when I would look at incorporating. So we get back to those general indicators I was talking about. Look at those and say, what's going to happen to my income? Am I already in top tax bracket? If that's the case, then yeah. I would say if you already have a tax problem and your income's over $220,000, even if you're going to take time off next year, definitely incorporate. And then you can pull out, you can control this year's income And you can control next year's income personally. You can pull some of the money out of your corporation next year when it makes sense to do that. So I hope that helps. Anything else?
Yes. Can or would you purchase a home through the incorporation?
Okay, this is a question I get fairly frequently. Can I buy my home through my PC? The first thing I want to know before I answer that question is, what's the purpose of the home? Is the home going to be your home, or is it going to be a rental property? Because if it's going to be your home, then I definitely would not purchase it inside of your professional corporation. I have a couple of clients who have gone against my advice on that, but the reason that you would not want to do that is a couple. Firstly, as an individual, when you own your home personally, you have access to what's known as the principal residence exemption. So let's suppose you buy a house now for $1 million, you own it for 5 years, you sell it in 5 years' time, and it's now worth $1.5 million. You've made a $500,000 capital gain on that. Now, if you own the home personally, then that gain is sheltered by the principal residence exemption. No tax on it. If the corporation owns it, then there is no access to the principal residence exemption because it's not owned by an individual. The principal residence exemption is only eligible or available to individuals. So that's the first reason. Second reason, if you're living in that house, you have to pay your corporation fair market rental value for that house, or it becomes a taxable benefit on which you have to pay tax. So people oftentimes say, well, look, I've got 500,000 sitting in my corp. If I pull it out, I'm going to pay all that tax. Why don't I just own the property inside there and live in it? Well, those are the reasons why you wouldn't want to do that. You'll miss the principal residence exemption, and you'll have to either pay your corporation rent to live in your own house or have a taxable benefit added to your income on your personal tax return. Now, that's scenario one. If you are looking to purchase a home that you're going to live in. Scenario number two, though, is if it's a rental, then I wouldn't be opposed to that. That's actually not a bad strategy. Why? Because if you've got money sitting inside your professional corporation, and what I would do, and this is the most common strategy, is to set up a holding company. Why do you have to set up a holding company? Why can't you just buy the property inside your corporation itself? Well, because the objects of most medical professional corporations is to earn income from the practice of medicine and activities ancillary thereto. That's the wording you'll see on articles of incorporation. Earning rental income from a home is not activities ancillary to the practice of medicine. So that's the reason we use a holding company. We use a holding company because, again, if the money's sitting inside of a professional corporation and you want to buy a rental property, you would have to pay tax on the money you draw out if you own that rental property personally. Remember, I talked about exposing your assets to litigation. The other reason I would look at using a holding company is to contain my risks. So I would set up a holding company. I would own the shares of that holding company, and then my PC would loan the money across for the down payment to the holding company. There's no tax on that loan. So you can get use of the money by setting up a holding company and then purchase the property inside the holding company. I have a rental property that I had a call on from the property manager a couple of years ago, and the property manager said to me, I just want to let you know that one of the appliances has fallen on a child of the tenant. Well, obviously I was most concerned about the well-being of the child, but I was thinking to myself, I'm glad I'm incorporated on that property, because if they're going to sue me, they're going to sue the corporation, they're not going to sue me. So that's a practical reason why using a holding company is a good strategy with respect to protecting your assets, as well as getting access to cash without incurring tax. So that creditor proofing consideration goes along with the tax advantages. Is there anything else, Mustafa?
Yes. Can you do a combination of salary and dividend out of the corporation to generate RRSP contribution room, but still have the flexibility of taking out larger sums for one-time purchases, such as house renovations, recreationals, and such?
Okay. Yes. In answer to that, yes. Can you do a combination? Yes, we do a combination of remuneration on mini files. That's part of the consideration we look at each year for clients. What's the best way to get money out of the corporation for them? Is it to take out salary? Is it to take out dividend? Is it to take out a mix of the two? So that is absolutely a consideration. Again, no hard and fast rules. Every file needs its own calculation, so you always want to run the numbers. There may be times where we would suggest to somebody, you know what, take out a dividend. Take out a dividend rather than taking out salary. Why? Well, take, for example, somebody who may be in their late 50s, they've paid into Canada Pension Plan, and they've maxed out the total amount of benefit that they could get from CPP. They don't need to pay into the plan any longer. I would say in that case, okay, take out dividends. Your income for the next few years is going to come out in the form of dividends rather than salary. Why? Because salary will cause CPP premiums to be paid. And if somebody earns $60,000 a year or more, they're paying about $6,000 in CPP premiums. It's a waste of money. So that's an example of where we can do a combination of salary or dividend or one or the other. I think the other question was about the other part of the question was to maximize RRSP contribution room, but also having the flexibility of taking out more money. So we run into this scenario quite a bit as well. Somebody's taking out, let's say, a combination of salary and dividend for $220,000, but they have a backyard renovation that they want, or a backyard project that they need a couple of $100,000 for. There's the option of a shareholder loan. I've done a video which talks about the 5 ways of taking money out of a corporation, which if any of you are interested in that, I'm happy to forward it along to you. But another way of taking money out besides salary, besides dividend, besides reimbursement of expenses is a shareholder loan. But that shareholder loan is tightly controlled by rules of the Income Tax Act. Why? Because the government says, hold on, person A shouldn't be able to take money out of the corporation and have access to money on a tax-free basis, unlike somebody who doesn't have the opportunity to incorporate and have access to that money. So it's a question of equity. So the Income Tax Act says, fine, shareholder loans are permitted, but under certain circumstances. What are those? Well, it means that if you've taken money out this year, you have to repay it or address it one way or another by the end of the following taxation year. So if your corporation, for example, it runs from January to December, and you take money out for that backyard renovation, you've got to have that money put back into the corporation, or you have to take it into income by the end of the following year. So how do you optimize that? How do you work within the rules but optimize that? Well, sometimes what we'll say to people is, okay, well, if you're going to do the backyard renovation, wait until, in this case, if their year end is December 31st, wait until January 1st of the next year, if you can, and take out the $200,000, if that's what you need, out of your corporation as a shareholder loan. You will now have 24 months to address that shareholder loan balance. Either you'll take some of that money and report it as income this year or next year, or you'll put the money back. But you will now have access to your money, but you have at most 24 months to have access to that money. Sometimes people will say, okay, what if I put the money back just before December 31st of the year following? Can I turn around and take it out the next day after that? No. That's called a series of loans or repayments of loans, and the Income Tax Canada Revenue Agency has taken that scenario to court and won. So you're best advised to stick within the rules of the Act and take out the money and make sure it's repaid in one form or other within that period of time. One other consideration with shareholder loans is the government again says, as a matter of equity, well, listen, Jonathan, if you're going to take money out of Tucker Professional Corporation, and you're not going to pay interest on it, and after all, I can do whatever I want. I can pay interest or I don't pay interest on it. Then if you don't pay interest on it, we're going to deem an interest benefit and add that to your income. They do that by using what's known as a prescribed interest rate. And it's a published rate from the government quarterly. At present, the prescribed interest rate on shareholder loans is 1%. So I have to, if I'm taking $200,000 a year out, I would have a $2,000 interest benefit, a deemed interest benefit, if I didn't pay my corporation interest. If I paid it $1,000, I would have $1,000 deemed interest benefit because the rate would be $2,000 of interest. So again, I've got to take that into consideration. But as long as you work within those parameters, you can still gain access to funds to take out money over and above for one-time purchases, as long as you work within the rules on that. Mustafa, are we getting to an end, or are there more questions?
Close. Just a couple more questions.
Okay.
This person is asking if you can briefly touch on incorporation together with a spouse who has similar income. Do they have to be in healthcare as well?
Okay. So similar income, not a healthcare professional. Okay. So, couple things come to mind on this. First of all, the non-healthcare person can be a shareholder of the healthcare profession. So a physician incorporates, the spouse can be a shareholder of the corporation. The CPSO member must, as a matter of public policy, must be the controlling shareholder of the professional corporation. The spouse cannot own voting shares, but they can own shares. So that is certainly a possibility. You also want to make sure that they're not a shareholder in another company, otherwise you will associate those corporations, which is not necessarily a good outcome. And so then we run into the next obstacle, which is if that person is a shareholder of the corporation, would you want to pay them dividends? And in this case, because of a change in the Income Tax Act a couple of years ago, there were rules put in place that when dividends are paid to shareholders of professional corporations, any amount paid is considered to be taxed at the top tax bracket. These rules you might have come across, called tax on surplus income, or TOSI for short, mean that if I pay a spouse or a child or a parent, family member, a dividend, it's automatically caught by those rules and taxed at the top tax bracket. So that is not a good outcome. It's certainly possible to make them a shareholder, no difficulty there, and dividends don't have to be distributed just because they're a shareholder. That's at the discretion of the corporation as to whether dividends are paid or not. So I would say it wouldn't make sense to pay dividends to a spouse in this situation. What you could do if this individual, and we run into this sometimes, is if the spouse is performing duties for the corporation, then pay them a reasonable salary. If they're acting as a practice manager or doing bookkeeping or administrative services and things like that, ask yourself, what would I pay an arm's length person to do these services? And they can be paid a salary, and a salary is not subject to TOSI, to those new tax rules. Dividends are, salaries aren't. So there may be some opportunity for splitting some income through a salary. There would need to be a job description, time tracking, just to demonstrate that this is equivalent to an arm's length relationship. But that's another way that income could be split. And here's another idea, which would be, you said in the scenario, I think Mustafa, the person said that both individuals have income of a similar level. So let's supposing the physician is earning $220,000 a year, I'm just making up numbers, and the spouse, the non-physician spouse, is earning $220,000 a year, and they need $100,000 a year to live on, let's say. Then what I would say is incorporate the physician, run all the income through that professional corporation, don't take any money out of the professional corporation. After all, they've got enough money from the non-medical professional, from that person's income to live. They can park all of the income of the healthcare professional inside of the corporation and get the benefit of a tax deferral. So that might be an option. I want to take this, just while we're on this topic, I want to take this one step further to a couple who are both physicians. So in the scenario this person was asking about, they were saying, you know, there's a physician and a non-physician as a couple, but what if both parties, both spouses are physicians? That doesn't automatically mean that you both have to have a professional corporation. It depends. It depends on the circumstances, but we have a number of clients where we are using one professional corporation for the two spouses to run the income through one corporation, so you don't have the costs of setting up a second one. and maintaining it. Now, that can be a temporary measure because incomes increase and so circumstances can change, where that you may want to in the future say, okay, we can't control income sufficiently enough, we need to set up a second corporation, and you break the parties apart with respect to the shareholdings. But I wouldn't automatically default to each party having their own PC automatically. I'd want to look at the circumstances on that. Anything else? You said a couple more.
Yes. How do you balance taking money out of the corporation to partially invest in RRSP/TFSA and in the corporation?
Okay, again, we come back to the idea of RRSPs and TFSAs and what role they play in this when there's a professional corporation involved. So I think where I would start with that is again managing income. So if in this case the need for funds is there, but if the individual is taking out less than $220,000 a year, then there is some room to take the income up to $220,000. Let's say somebody's taking, they say, all right, I want to max out my RSP, so just give me enough salary to max out my RSP. And so we would give them about $155,000 a year. That lets them put $27,000 into their RSP typically. And so in that situation, that could be a possibility. That's a bit of a shell game. Why? Because the person reports income of 150, they take out 27 for their RSP, so they drive their income up, only to turn around and take the money and put it in an RSP. That's a shell game. So not really an advantage there. But if somebody does want to build up their RSP, or if they want to make investments outside of their RSP, then what I would do, where I would start, is to say, okay, how much money are they earning at present? If by giving them more money, it takes them into the top tax bracket, then I probably wouldn't do that. I would say leave the money inside the corporation, invest it there. But if the person has room to take their income up to $220,000 and the difference between living expenses and that amount permits them to invest, that's the balance I think I would strike and take out the money and put that into or put that into investments that are owned personally. Why do I say that? Well, because you have to be careful on the amount of tax that's paid on investment income. When we talk about 12.2% being the rate of tax on income earned inside of a corporation, remember that's on active business income. That's income from the practice of medicine. But when we get into investment income, that's taxed differently. It's taxed higher. And so we will firstly want to say, okay, can we manage the person's personal income and not get them into the top tax bracket? But we might find ourselves too and pull out money up to that amount of money and invest it. Why? Because it actually could be cheaper to earn that investment income personally than it is in investing it inside the corporation in certain circumstances. So again, I come back to that article by Jamie Gollenbeck, which if you Google it, small businesses and RSPs, should get you to that article. It will give you an in-depth analysis of investment income earned inside of a corporation versus earned personally. So I would recommend that you look at that article. They say in that article, Gollenbeck quite rightly points out that the tax cost can actually be higher on investment income earned inside of an investment corporation. If, for example, you're earning it as dividend income or as investment or as interest income. But if you buy the types of investments like an ETF, which doesn't distribute investment or it doesn't distribute interest income or interest, and it only appreciates in value, in those instances, you can be better off by letting those investments grow. But then you're going to run into passive income rules, which was another change that came up a couple of years ago, that the government said the first $50,000 of passive income that's earned inside the corporation, fair enough, we'll let you do that. That should last you for up to $1 million of investment, for example, if your investments are earning a rate of 5%. If that's the case, you can have $1 million inside your corporation, but anything above that $50,000 threshold starts to claw back the small business deduction. It isn't the end of the world if that happens. It just means your corporate tax rate goes from 12.2% up to 26.5%. So you're still getting a deferral of about 26, 27% on income over $220,000, which is better than a kick in the head. But nonetheless, that is a factor to be considered. But so I don't want to go too much into any more detail on that, other than just to be aware of the types of investments inside of a professional corporation and the type of income tax you're going to pay on that. And also that article by Jamie Gollenbeck. There is another final point I want to use to address this question of the balance of withdrawing funds from a corporation. I'll use an unincorporated individual for now, just for simplicity. This is a client. This individual works in the bank, earns about $250,000 a year of salary, has no control. They can't incorporate salary. They're an employee, so they're earning $250,000. The question here was, is there a balance to investing in an RRSP or leaving the money inside of a corporation? A corporation isn't an option here, but remember I said they're earning $250,000 a year. What's that mean? It means that $30,000 of that $250,000 is taxed at the top tax bracket. They're already into the top tax bracket. So that extra 30, that's the amount between $250,000 and $220,000, is taxed at 53.53%, about $16,000 of tax on that extra $30,000. That's where the RRSP can come into play. In this case, the person had a contribution room of about $70,000, and they were earning investment income outside. So I said, you know, put your money inside your RRSP. It's the only option you have in this case. So put the full $70,000 in, and you might think, great, wow, that would take their income from $250,000 down to $180,000. That's a great outcome. I would do it slightly differently. I would say put the $70,000 into the RRSP, so it's now earning income inside on a tax-deferred basis. It's about the only option this person has. And then when completing the tax return this year, claim of that $70,000, just claim $30,000 of that contribution. RRSPs are a discretionary deduction. You can decide how much you're going to claim, if anything, of that contribution. You could let it sit there for a couple of years and not claim it. The money continues to grow tax-free on a tax-deferred basis, but you don't have to claim the full $70,000. So in this person's case, what I said was, all right, put the full 70 in, shield that money from and the investment income from tax, and just claim 30,000. Why? Because it will now get her out of the top tax bracket. So this year, of the 70,000, we would claim 30,000. That means that $40,000 of that contribution gets carried forward for deduction. Next year, the individual is going to earn the same $250,000 as an employee. They're going to be in a top tax bracket again. They've got $40,000 remaining of that 70 that they haven't claimed. Claim 30 of that, bring their income down to 220 again, and get out of that top tax bracket. And then the third year, they're going to earn $250,000 again. They will have more contribution room that they can contribute to, so they can put more money in. Again, just bring the RRSP, or just bring the income down to $220,000 by claiming just enough of the RRSP contribution to get them out of top tax bracket. So I know I went on at length on that, but that would be a way, and you could do the same strategy for incorporated professionals. You might run into that situation where the person's incorporated, but they do some locums outside of the province, and so they've got income that's high there, and we want to get control of that. Then that's where an RRSP could be a useful vehicle to control income. All right.
Last question. Is the tax break from investing in the RRSP inferior or superior to the tax advantage of leaving money in the corporation to invest if you still plan to limit withdrawal from the corporation to under $220,000 per year?
Okay, I've kind of addressed that in my responses. Again, I'm going to mention that article by Jamie Gollenbeck, because the question here is, as this individual has mentioned about the tax break from investing in an RRSP, is it better or worse than leaving the money inside the corporation? And again, I would say it depends. It depends on what the money is invested in inside the corporation. If it's invested in, mutual funds or stocks that are paying dividends, then I would lean towards getting the money out of the corporation, or changing the mix of my investments inside the corporation to just investments that yield capital gains. But and that's how I would that's how I think I would manage that. And again, look at that article. So I think I would leave it at that and just say that the type of investment that's included, the type of investment that you have inside that corporation will determine whether it makes sense to earn that type of income. If you're dependent on dividends or interest income for a living, then maybe you want to pull it out. There's one other consideration though, and I haven't mentioned it. It doesn't oftentimes come up with physicians because physicians' practices are not often sold. There are certain types of practices that can be sold, and occasionally we run into this. But if you're looking to, and it's more common with dentists, for example, where a dentist would sell their practice, and the capital gain on the sale of the shares, you can get what's known as a capital gain exemption. But it's tightly regulated in order to qualify for that exemption, and it's on $871,000. I think it's $873,000 of capital gain, if my memory serves now. That, you know, if you sell your practice for $1 million, for example, as a dentist, then you could get 873, if I recall. I think it's indexed of that $1 million. If you qualify, it could be sheltered completely from tax. So that's the capital gain exemption. Why do I mention that in investments? Well, if you have investments sitting inside that corporation, that is going to put you offside of that capital gain exemption. And so that could be a reason why we want to keep pulling money out of the corporation and putting it into RRSPs or putting it into whole life insurance policies personally to shelter that investment income so as to get access to that capital gain exemption. That would be another reason why we would want to strike a balance between leaving money inside the corporation versus pulling it out. I think you said that was the last question.
Yeah, that's it for the questions.
Okay, very good. If you're interested in incorporating, if you'd like some further discussion about this or instruction or just to bounce your scenario off of me, I'd be happy to talk to you about it. You can see my contact information is on the screen, so feel free to reach out. I'd be happy to have a conversation with you or to clarify anything that I've said during the course of this. I hope this has been useful and informative. Just to let you know, if you have any colleagues where you work with medical residents who are just starting their residency, our next webinar will be geared towards those folks and the steps that they need to put in place during the course of their residency. So if you have any colleagues or residents that you're working with or family or friends that fall into that category that you think might be interested in that, let them know about that. And we'll send out invites to register if you'd like. Pass that email along to those people, and they may find that session useful. Again, thank you everyone for your time. I hope this has been informative and helpful. And as I say, feel free to reach out if you have any other questions, but I think we'll leave it at that. Mustafa, thank you for moderating today's session, and we look forward to seeing people inside of our next webinar. Thank you, everyone. Take care and stay safe.